Good afternoon and welcome to the press conference following the quarterly meeting of the Shadow Financial Regulatory Committee. We're starting a little bit early today because we have 5 statements, even though you don't have them all, and we want to give time for Q&A. Let me introduce the Shadow members who are sitting at the table. Chester Spatt, Richard Herring, you might imagine him sitting there. He's so small that you can't see him. Frank Edwards, Columbia, Catherine Tran from Wharton, Ken Scott from Stanford. I'm George Kaufman. Ed Kane is in the audience from Boston College, and Ken Dam is in the audience. Ken Dam is in the audience from the University of Chicago. And here, this is Richard Herring. And as I said, before we talk about the statements, I want to remind you, if you weren't here last meeting in December, that in October, we had the biannual summit or joint meeting of the 6 Shadow Financial Regulatory Committees throughout the world, 2-day meeting on the world in crises, and we issued an e-book, and that's available free of charge. It's on the website of the American Enterprise, the American Enterprise Institute, and the information there will be as you leave. You could pick that up along with the statements. It's also on the website of the Wharton Financial Institution Center. And can you give us the URL? No, he can't. So you just Google it, and it's a free book. It's 6 chapters written by each of the 6 committees, and a statement on where we think the Eurozone and the Euro is heading. So that's exciting reading, and best of all, of course, it's free. Let me deal with the 3 statements that I have in front of me, and then we'll go to the other 2 as soon as they come out. Statement 323, which is on alternatives to the proposed risk-based capital standards. 324, which is some lessons from MF Global debacle. And 325, which is regulation of money market funds and systemic risk. We'll start off with 323. And Catherine, do you want to do that?
So our statement is on the alternatives to the proposed risk-based bank capital standards. The Dodd-Frank Act requires that credit ratings be removed from regulations, and this has a significant impact on the capital regulations, in particular the foundation approach, which uses credit ratings to determine risk weights for capital standards. As an alternative, in December of 2011, the banking agencies proposed new guidelines for determining risk weights. In the appendix to the document, we've provided some illustrations of the guidelines. The purpose of the illustrations is really to show you the complexity and the somewhat arbitrary nature of the guidelines. Our statement makes 2 points. Our first point is one that we've made before. In past regulations, or past statements, we've made the point that we believe a leverage ratio standard overall is preferred to any capital standard based on risk weights. And we think the complexity and arbitrary nature of the guidelines that replace credit ratings for determining risk weights just strengthens this position. It's difficult to come up with a system using risk weights that's useful in determining minimum capital standards. The second point that we make in our statement is a practical one, recognizing that the agencies are likely to retain risk weights in order to determine capital. And we encourage the agencies then to look to a hierarchy that has already been established in the accounting standards for using market data, but for understanding the reliability of the market data and when models versus market data should be used. The accounting framework was developed prior to the financial crisis. It was vetted and determined to be implementable. It was road tested during the crisis, and implementation issues arose. So the standards have evolved. This hierarchy has been developed that is relatively implementable. So in short, our conclusion that is that if the agencies are going to continue to use a risk-weighted asset-based capital standard, then there's no reason for them to proceed down a new path when there's already a well-established approach to determine when market data can reliably be used to determine creditworthiness.
Thank you, Kathy. We now go to statement 324. The detective, where is that missing $1.6 billion? Do you have it, Chester?
No, it's not in my pocket. That's for sure. So statement 324 is about lessons that we're learning from the MF Global debacle. The surprising disappearance of $1.6 billion during the collapse of MF Global clearly raises some questions about the workings of our system and the integrity of key aspects of our system, and whether there are sufficient safeguards to protect the system and customer funds from undisclosed risk-taking. The collapse raises a variety of important questions about the effectiveness of the rules for segregating customer funds, especially given the absence of insurance arrangements, the issues related to the monitoring of firms' internal controls, and the effectiveness of firm risk management structures. Now, while perhaps many of you are familiar with SIPC, which protects equity account customers against fraud, futures account customers lack similar protection, and certainly the issue that events of last fall raise is whether there might be a need for some sort of insurance fund in the case of the futures. Now, despite the traditional segregation of customer funds from broker firm funds, since 2005, futures brokers have been permitted to deploy customer funds under CFTC rules, including potentially using the customer funds in certain circumstances for internal types of funding under certain conditions. And this underscores a significant conflict of interest that's been present in the system. The CFTC actually put out a rule proposal to address this conflict in late 2010, but delayed acting on this in part at the behest of the leadership of MF Global. Shortly, of course, in the aftermath of the collapse of MF Global, the CFTC did move forward, but we think more broadly, the situation certainly raises the possibility that one needs a stricter system of segregation of customer funds from the broker's resources, and that perhaps even distinct asset titling may be needed to prevent misappropriation of the funds and/or a more explicit type of insurance mechanism. Now, in the case of MF Global, there appear to be several significant governance failures. First, several days before the final collapse, customer losses appeared on an overnight basis, and these were not immediately resolved. One of the centerpieces of Sarbanes-Oxley, of course, was the periodic certification by management and auditors of the absence of material weaknesses in internal controls. The emergence of customer losses on an overnight basis raises questions about how they could have arisen given the prior certification of the absence of material weakness in internal controls, which had been attested to by both management and the auditor. A second important apparent failure in governance that the situation illustrates is how risk management occurred within MF Global and how it needs to occur within a trading firm, which risk management, of course, should be accorded the highest priority by a trading firm. Yet at MF Global, it appears that the chief executive officer appears to have bypassed risk controls to have made major trading decisions. Risk management, it's important that risk management be independent and not influenced by those making trading decisions. And indeed, this again ties back to Sarbanes-Oxley, which emphasizes the importance of the role of segregation of duties and failures along those lines, which similarly suggest failure of internal controls. Finally, recent events also highlight some of the difficulty in managing exposures through our global financial system. In particular, in the event of failure, there are huge difficulties in obtaining clawback when there's international jurisdiction. Indeed, this is an important issue that we really started to learn about at the depths of the financial crisis in the aftermath of the collapse of Lehman Brothers. Lehman London is still involved in obviously a whole range of very significant litigation that perhaps will take many more years to really come to fruition. But from a mechanism perspective, there doesn't seem to be much, if any, apparent progress with respect to dealing with these issues on a going forward basis. Indeed, just last week, the trustee seeking funds for MF Global's customers, James W. Giddens, expressed the view that $700 million of the now anticipated $1.6 billion in customer claims reflect funds that are based in London. So customer claims, in fact, would have to be expressed in a different legal framework.
We go to Statement 325, Frank Edwards on regulation of money market funds and systemic risk.
Good afternoon. It's a pleasure to be here with you today. I want to talk about money market mutual funds, something all of you probably use and have an account with, so you certainly have a personal interest. I myself had a personal interest in this for a long time, academically and professionally, and our committee has had a long-standing interest in this subject too. Why? Well, primarily the interest stems from what happened during the 2008 financial crisis, when money funds, money market mutual funds, experienced, should we say, a destabilizing run of investors on their accounts, triggered by the collapse of Lehman in 2008, which triggered, as you remember, the liquidation of the primary reserve primary fund, which was an institutional money market fund. That is, instead of retail like you and I using it, used mainly by institutions. And that had, the fear was that would set off a systemic effect that could spill over into other money market, such as commercial paper, in particular commercial paper. And that ultimately led to the federal government intervening to temporarily guarantee all investors in money market mutual funds. So that's tantamount to, at least on a temporary basis, expanding the federal safety net, which we've always been concerned with, as to the extent to which when should we throw a safety net over our financial institutions. So this was, in our view, really a very big step to potentially expand the federal safety net to a 2.7 trillion, then $3.7 trillion industry that was not guaranteed by government insurance before. So what's new? Well, so we have the issue, and over the last couple of years, a number of initiatives have been made to do something about this, but nothing much has come of it. So very recently, in the last couple weeks, SEC Chairman Mary Shapiro said, money market funds remain susceptible to runs and to a sudden deterioration in the quality of holdings, and we need to move forward with some concrete ideas for proposals to address these structural risks. She didn't waste any time, because she also said in a press interview that the SEC is in fact considering releasing a new regulatory proposal, which would do really two things. One, impose additional capital and liquidity requirements on money market mutual funds, kind of bank-like regulation, if you will. And secondly, replace the fixed $1 net asset par value redemption rule that is now imposed, that is now applied or used by money market mutual funds with a floating NAV valuation of money market funds, so that the investor therefore would have some risk of variation in their market value. Okay, so that's where it stands, and it's obviously an extremely controversial proposal. There are going to be a lot of people who don't like this because it changes the status quo, and it does mean some additional regulatory changes. That's not the first time we've addressed this issue. In February 14, 2011, not so long ago, in our Statement 309, we said, the committee, that we proposed that the SEC shift to a floating NAV model for institutional money market mutual funds, and that we even didn't do it in that statement. We considered possibility of imposing bank-type regulations on money market mutual funds if that were not done. So what do we do now? Well, after that history, we've actually, after further discussion and analysis, we've been persuaded that our previous proposal should be expanded to encompass 4 additional aspects. First, apply the proposed floating NAV model to retail as well as institutional money market mutual funds. We didn't do that. We didn't say that before, but now we're saying do it for retail as well as institutional, so that would be all money market mutual funds. Second, permit money market mutual funds to exempt out of this the floating NAV model if they are sponsored by fund companies that provide an explicit contractual guarantee to investors in these funds that their investments will be redeemed upon demand and at a par value of fixed $1. That means if indeed there is a fluctuation, but they still stand ready to redeem at par value, then the fund company should be on the hook for making good on that proposal. And just to make sure that happens, the third component of this is to impose capital and liquidity requirements on these fund companies who have this obligation, of capital and liquidity requirements so that they can meet these obligations. That's very similar to what the SEC proposed or is considering proposing. They haven't done it yet, as I understand. And then finally, mandate that all money market mutual funds publicly disclose sufficient information to assure that all money market investors are aware of and fully understand the differences between sponsored guaranteed money market mutual funds that will operate on the floating NAV model, and also the difference with FDIC insured deposits. So in bottom line, we believe that this regulatory structure will greatly moderate the systemic risk associated with the present structure of the money market fund industry, while still enabling the industry to provide a variety of money market mutual fund products and investors to benefit from the competition and financial innovation that money market funds unquestionably provided in the past. We're not alone also. Even the Wall Street Journal has caught on. Today's editorial is Money Funds Makeover, and I think they've read our statement now and fully understand it by this time. We wrote it last night. They agree we should move to a floating NAD model themselves, and so I may start reading the newspaper again. Thank you very much, and we can take questions afterwards. So.
Thank you, Frank. We'll now go to one statement that I don't think you have yet, 326, which is on the Volcker rule, which is also in the Wall Street Journal this morning, and we wrote this last night. Ken Scott.
Well, I would like to claim that the reason you don't have the statement is that we thought that to make it more comprehensible, we would supply you with a copy of the Volcker Rule along with a copy of our statement. The printing office balked because the rule is a 530-page proposal. So in the absence of the proposal itself, we do have a one-page statement to contrast brevity with length. And in it, we take up one aspect of the Volcker Rule, and that is the ban on proprietary trading, which contains an exception for market making. So what is the distinction between proprietary trading and market making? If you're making markets, you're maintaining an inventory, you're trading, you're taking, moving securities in and out of your position all the time. You bear a certain amount of proprietary risk, which can turn into a proprietary gain or loss. So precisely how is it that you are to distinguish market making then from taking on proprietary trading? The rule, as proposed, lists 6 factors that are to be taken into account. They aren't operationally defined, and there's no indication of their relative importance. So the result is that there is going to be necessarily considerable uncertainty in trying to make, on a trade-by-trade basis, a distinction between market making and proprietary activity. How do you deal with this? Well, you could try to take these 6 factors, which are general categories, and try to define them in some kind of more precise operational manner. That seems both difficult and unlikely to occur. And that means that enforcing the rule, supervision is going to play a very large role and bear a special burden. And to try to minimize adverse consequences from undertaking this, which has drawn a lot of opposition not only from the industry but from central bankers abroad and across a wide variety of commentators. The rule posed 383 questions for commenters to respond to. We're responding, I guess you could say, only to a very small fraction of the issues presented by the rule. And so we suggest a couple of modest but perhaps helpful steps. First is to build into the rule a presumption of validity of the trade classification being made by an institution in conducting its market-making activities and applying these 6 factors when it comes time for the supervisors to audit or oversee compliance, which sort of nudges in the direction of recognizing and having a certain element of tolerance for the precision of the rule. And secondly, perhaps it would be useful to clarify the distinction between securities trading and commercial banking simpliciter, which is close to the heart of Paul Volcker. In a stunning development today, he came out in favor of the Volcker Rule. And that would be to put security trading activities in a separately capitalized subsidiary. The rule would still apply to them, of course, but there would be a distinction then between commercial banking supported by the safety net and securities trading that would be perhaps a little more operationally clear and easy to deal with in the event of failure. So the end result, we think, we hope, we suggest, might be a simpler rule that would be both easier to comply with and easier to enforce.
Thank you, Ken. Our final statement, I'm not sure whether you have a copy of this or not. Not yet. They'll be in later. 322, again, we stay with the Dodd-Frank bill, and then we'll talk about the Federal Reserve Board's proposal for enhanced prudential standards and early redemption requirements. Dick?
Thank you, George. This is a proposal of an advanced proposal of rulemaking that appeared in a very quiet part of the year, just before Christmas, but it's really crucial. The Federal Reserve Board sort of filled in the missing piece of how you were going to get from the FSOC apparatus to a state where taxpayers would never again have to pay for a bailout. And they're placing very heavy emphasis on enhanced supervision and early remediation, which is in effect a more sophisticated form of prompt corrective action. The idea behind it is that all of the included institutions, and this would include by law all banks 50 billion and above, there are about 39 of them, and all non-bank financial institutions designated as a potential threat to systemic stability by FSOC, the Financial Stability Oversight Council, of which there are presently none. All of these would be subject to these enhanced supervision measures. The intent of the proposal is to keep these institutions from taking on excessive risk exposures, not only to credit risk, but to liquidity risk and to interest rate risk or to other kinds of market risks, but also to provide a series of triggers that would permit the authorities to intervene and try to remediate such institutions before they become bankrupt. It's a very complex piece of regulation. Although I guess it's not quite so bad as the Volcker Rule, which has a much narrower scope. It has 173 pages, and it poses 95 questions. Now, in a way, I think this is good because it shows they haven't firmly made up their minds on a number of issues. The proposed rules cover capital and leverage requirements, liquidity requirements, limits on single counterparty exposure, which is something that we didn't have very much under control before, standards for risk management, which are very process-oriented, and standards for stress testing, which are sort of the new view of how best to try to anticipate the future, and a description of this early remediation regime that is supposed to make prompt corrective action work more effectively. Naturally, given the complexity and vast coverage of the proposed rulemaking, we can only comment on a few aspects at this time, but we're likely to take up others later on because it is a very, very important piece of potential legislation. Perhaps surprisingly, I'd like to start with a compliment to the Federal Reserve Board. We're in fact pleased that they have at several points included some forward-looking market-based measures in their targets and indicators of the health of the financial system. The tendency before, and you will all remember the embarrassing cases, is that every single one of the institutions that collapsed or was forced into a merger actually did so when their regulatory capital was way above average, not just even close to the margin, which meant that the capital requirements really were not very good. And this was an embarrassment not only for the regulators, but it certainly harmed the system as well. Well, so one of the things they're going to do is require that banks hold a newly defined Tier 1 capital, which is basically equity and other instruments that can absorb loss without taking the firm through bankruptcy. And they're going to require that that be 5% based on two different scenarios. One, a baseline scenario, which is the easy one, and the other one is a stress scenario that's severe. They're going to do another one that's very severe, and it is very severe indeed if you look at the latest one they've put out. But it will give you an idea of how the bank is likely to perform if the economy should have much worse performance than we expect it to. The committee is pleased to see that this and other forward-looking indicators are included as triggers for early remediation, because if you wait on capital requirements, it's simply too late. Traditional capital requirements are based on accounting standards, and they can be manipulated, and they always lag well, I should say virtually always lag the true economic condition of the bank. And so they've done a number of things to try to fix that, including relying on these kinds of scenarios, not only for capital but also for liquidity. And they've even been so daring as to actually look at a direct market indicator. They've chosen to focus on the implied volatility of the institution's stock price. And one can do that now relatively simply with a well-known algorithm. We're a bit uneasy with focusing on this one measure because having all known Charles Goodhart for a long time, we're much aware of Goodhart's law, which warns that once you make any particular indicator something that is a linchpin for policy, it's going to lose a lot of its value because both the regulated and the market will try to manipulate it. The committee would recommend instead another market indicator, and I think the board was wise to focus on stock prices because neither the CDS market nor the bond market has liquid enough to reveal information reliably. Remember that the stock market never did stop trading, even in the worst of the crisis. But we think that instead of relying on a single reading, that they should use a moving average. And by using a moving average, they smooth out a lot of the day-to-day volatility. And it's really only if you see a long, sustained downturn in stock prices that you're relatively sure that the market knows something that perhaps the regulators haven't yet factored in. Just as an example of that, I might point out that Citibank had a regulatory capital ratio of 12.5% when its shares were trading for $1. So obviously there was a lot of information in share prices that the regulators were simply not taking into account. The length of the weighted average can be, debated. As it happens, Charlie Calamares, another member of the committee who's not here today, and I had worked on a paper trying to see how things would have looked in 2008. And it turned out that a 90-day moving average would have done a perfect job of separating the banks that required intervention or were forced into merger or in fact failed from those that passed the SCAP test, the Supervisory Capital Assessment Program. From that moving average you can, and the assumption that the institution will pay off its liabilities in full, you can derive a market-based inference about the value of the bank's assets. And that's always been the difficult thing to do because banks specialize in holding assets that cannot be easily marked to market. It's the level 3 sorts of assets that Kathy talked about. Still, there are some things that we're uncomfortable with. And one of them is that parts of the proposal really ignore one of the main lessons that we all learned from the crisis, which is that in distress, it's not the regulatory capital measures that matter. It's really the institution's ability to absorb loss without going through bankruptcy. Now, the Basel Committee was smart enough, and the U.S. was certainly a participant in it, to redefine Tier 1 capital to be exactly that. Yet we find the Fed basing its measure of net exposures to counterparties on a bizarre notion that is both obsolete and really expansive. It's called consolidated capital stock, and it uses the obsolete version of Tier 1, which includes a lot of stuff that can't absorb loss without going through bankruptcy, and Tier 2, which is just obsolete, period. And it even adds on a factor that is rather bizarre. It's excess loan loss reserves that could not qualify for Tier 2 capital. So this is getting into some very dodgy territory. It's not clear why they added this extra complexity. I think there's no doubt the world's going forward with the more sensible Tier 1 measure, and they could easily have restated it. One can only speculate that they wanted the measures to look tougher than they really are. But this seems like unnecessary complexity in an already very complex set of rules. The exposure rules are apply to literally everyone except for the federal government, who always wants to be able to borrow, and any institution which is, in fact, in conservatorship or receivership, read Fannie Mae and Freddie Mac, so long as they are in receivership or conservatorship by the federal government. The FRB has also taken a very careful assessment of how to measure net exposure to counterparties, which is not a simple thing to do, because banks have so many different relationships with a counterparty that it is a technological challenge at the very minimum to get it all straight. But one of the places where they have posed a question, and I think it's a genuine perplexity, is that they have left out institutions that are not actually consolidated with the bank. And as you may recall, during the crisis in 2008, two of the real trouble spots were the SIVs, Special Investment Vehicles, or SPEs, Special Purpose Entities, that were not strictly speaking owned by the bank, and under the accountant's view, not really controlled by the bank, but nonetheless had a reputational relationship to the bank. And I think in virtually every single case, the bank anteed up to protect these entities. They either took the assets on their balance sheets or they lent to them to keep them going. So it was a reputational link that made it an exposure, even though the bank wasn't thinking of it as such. In addition, as Frank has just talked about, money market mutual funds became a really major drain on banks during the crisis, because many sponsors anteed up literally billions of dollars to keep their funds from breaking the buck, again, because they didn't want to ruin their reputation. In part, these dilemmas may be solved through other means. The FSAB, or the Accounting Financial Standards Board, has already moved to eliminate the sort of exempted special purpose entities, and the Europeans have gone still further. So I think there's every hope that convergence will take all of this stuff back on the balance sheet. And if, of course, the world follows our suggestion for dealing with money market mutual funds, they will no longer be a potential threat either. But it is a very, very important proposed rule. There are opportunities to comment on it until March 31st, but it is, in some sense, the guts of what will make the Dodd-Frank Act work or not, depending on how it's implemented.
Thank you, Richard. I might note in Statement 323, which was handed out and discussed earlier, there's a page missing. So on the way out, you could pick up a couple of the statements that have not been circulated, the information about the free e-book, and the missing page of Statement 323. So now it's time to open it up to the floor. Again, if you identify yourself, wait for the microphone. I think there's some microphones floating around. And direct your question to a particular member of the Shadow Committee. Any volunteers? Good, I could fly back to Chicago early. No questions? Yes.
Excuse me, I'm Bob Feinberg, and I've been consulting on the financial crisis since 1973. And I wish I'd had a chance to prompt someone before, so I wouldn't be surprising anyone. But I start with Professor Herring and certainly anyone else who might comment. We've talked about the 1.6 billion. The number keeps going up, by the way, that's missing from MF Global and probably just went poof. And if you could have bought that stock from when it was only 600 million, that would have been a good, you'd have good returns in a short time. But there's supposedly 16 trillion that has been cycled through, and I've even seen higher numbers than that. People are trying to figure out that the Fed has sort of sloshed into the system, apparently to prop up a constellation of banks that are questionable financial condition. Is anyone following that? And I must say, I would not have asked it if we hadn't had this lull, because I don't like to spring it on anyone, but it also ties into the EU.
Yeah, I think that's the place where people have been watching it most closely.
To see whether the swaps that are supposedly assisting the European community in coming to grips with their problem are also backstopping losses that may or may not be, that are the banks you were talking about.
Yeah. The EU
vulnerable.
banks have received massive loans from the European Central Bank for less than 1%, which gives them a very easy carry trade, where they can buy back their own assets, or they can, buy back their own liabilities, or do virtually anything, and it will be profitable. And so I think they're trying to help them rebuild their capital by giving them an easy way to make profits. Actually, I think one of the very best analyses of what the Fed did during the crisis was a reporter from Reuters who actually dug through the data dump from the Fed and figured out who were the biggest borrowers and what were their peak amounts and what were their average amounts. And it was very surprising to see who the Fed was supporting. It was not just U.S. banks, although the usual suspects appeared, but it was a very large and broad range of very dubious international banks as well.
John Foley from the Federal Housing Finance Agency, and I guess this is for Professor Edwards. I mean, it's interesting, and I suppose a good thing that money market funds will now, have their assets valued so that they can fluctuate. That will presumably drive people who really don't want to break the buck into the most logical category, which is bank deposits, where as long as you have only $250,000 in an institution, you're not going to break the buck as long as the FDIC is around, which will have broader ramifications, presumably, because as we know, the money market funds would, for example, invest in European bank debt. They don't any longer. The European banks, of course, have trillions of dollars of U.S. dollar loans, which, without U.S. dollar deposits, so they've got to get the money from somewhere. I think they're probably getting it, again, through these swaps through the Fed. And the long and the short of it is, are we really moving towards a more market-based system where people are actually taking risks, or are we instead driving people more towards the remaining risk-free assets that are ultimately backed up by the Federal Reserve or the various global governments?
I think it's a good question. And I think that, really what you're talking about is what's the fallout of this new regulatory program. Well, keep in mind that the money market mutual funds has fallen from a $3.7 billion industry to a $2.7 billion industry in the last couple of years. Why? Trillion, yeah.
Trillion, yes.
Trillion. Why? Why? Because the rate of return is lower than they used to get. Investors used to get. So you can just reason from there that, yes, to the extent that the return versus the risk is going to be less in the future, these will be less attractive than they were in the past. Of course, keep in mind that as taxpayers, we were subsidizing that risk-taking by the investment and mutual fund investors. So we don't really see really a logic for taxpayers to have to extend that guarantee. Now, the other part of our proposal is to allow fund companies to, in fact, still run or operate or sponsor net par value funds, which would be just like they are now. And if they can do that cheaper than banks, meaning they can offer a better rate. And if that guarantee is credible, then why wouldn't investors stay with the higher return money market mutual funds than the banks, which do pay very low returns? So we're actually giving the industry an alternative to going to shrinking, as long as they can do it efficiently, more efficiently than the other guy. That's what competition is about.
Well, if there are no more questions, thank you for coming, and we'll see you in May.